Welcome back to another edition of Happy Half Hour. Today is March 4th, so we'll be looking back at the past month, talking about markets, economy, and there's nothing to talk about. No shortage of things to talk about, I should say. This is Toby Weber. I'm Nick Shermans. I was trying to make a joke that didn't land very well. What's going on in your world, Toby? What are you thinking about?
I like this new podcast studio. We've got the plant between us. I feel a little bit like Between the Ferns.
Between the Ferns, I was trying to think.
Zach Galifianakis.
Oh, right.
But no, ready to get into it and cover the subjects today.
Okay, so what's top of mind for you?
The first subject I wanted to talk about is the most obvious one. We've seen a lot of volatility over the last couple of weeks. Trump tariffs, inflation readings, people concerned about what's going on with the new administration and the impact on the economy and the markets. What are you taking away from the recent volatility, and should investors be thinking about?
That's a lot of stuff to unpack. That's 8-part question. I'll do my best. First off, I think we need some context. The market is down, and when I say the market, I mean the S&P 500 is down 2%, coming off 20+% in 2023, 20+% in 2024. If you've been paying attention to our writings, we've been covering a lot of this, how U.S. large caps have been really the game in town over the past decade plus, coming off a favorable 23 and 24. We said investors should revise their expectations down. There was a lot of froth in the AI trade. So when you zoom out and look at things, it's hardly grounds to panic. The investment universe extends beyond the S&P 500. And when you look at some of the other asset classes that we own, that we've talked about in previous blogs and podcasts, REITs are positive, bonds are positive, gold is overwhelmingly positive, foreign stocks are positive, emerging markets are positive. So it's important to note our portfolios are diversified. We own other asset classes. There's no shortage of headline risk, but when you zoom out and look at context, it's really not all that bad. And I always say that if you couldn't click buttons on the internet, you just talked to your friends and went on walks with your dog, things really aren't that bad. So know that regardless of what happens next, we also do have a framework to mitigate risk. And I encourage those that watch our market commentary or follow our blog to look at my latest commentary. I actually cover several of the quantitative rules that we use to make portfolio decisions, either buy, sell, or hold.
Yeah, it can work both ways, though, because we've had some good stretches in 23 and 24. So when you do get the volatility, it can kind of unnerve people.
Mm-hmm.
So any advice for folks on how to deal with this new environment where we are likely to continue to see more volatility? The commander-in-chief brings volatility with him, whether it's a tweet or a comment, and the market tends to react pretty significantly. So how would you advise folks to stay focused and handle the increased volatility?
I would actually separate two worlds here. So one is the volatility and headline risk. So what you see on social media, what you see in legacy media, that is volatile. When you look under the hood and track the VIX, which is one of the measures of how investors expect future stock prices to move, the higher the VIX, the wider range of potential outcomes, the lower the VIX, the tighter range of potential outcomes. And that's a simplistic view, but the actual VIX up until the last 2 days was well below the long-term average. So when you look under the hood at markets, markets haven't really been volatile up until the last week or so. Okay, but still it's in a acceptable range. So that's one of our rules that we track. And historically, when you go back 40 or 50 years, when the VIX is below 19.5, which is the 80-year average or 60-year average, S&P returns are quite good. When the VIX peaks above that number, 19.5, S&P returns are a little more challenged. So that's something that we're watching. And I believe today is Tuesday. I think last Thursday, the VIX actually breached its long-term average of 19.5. So that's something that we're very closely watching. The other thing that we're closely watching is credit spreads. It's really hard to predict short-term movements in stock prices. Credit spreads are about as accurate as it gets. And what we're actually watching and what a credit spread is if you think about the risk-free rate, call it a U.S. Treasury bond at 4%. The spread above that would be the cost of a lower quality company to borrow. So let's say the risk-free rate is 4%, credit spreads are at 2. That means for a lower quality company to borrow, it would be roughly 6%. Okay, when those spreads blow out, that signals stress in the economy, a market crisis, and is often a precursor to market sell-offs. I don't want to get too deep in the weeds, but credit spreads are still historically low. Now, the counter to that is the seeds to the next crisis are often sown when credit spreads are low. That's akin to a risk-on environment. And I always say dumb capital allocation decisions get made during good times. It's kind of the old saying, stability breeds instability. So one of the things that we pointed to is kind of this FOMO trade into AI, US large cap. A lot of investors, a lot of prospective clients that we see have crowded into the best performing names. And as we've seen this year, as we've seen when we look back at history, that probably doesn't end well.
Yeah, and I think the only thing I would add is that we're, as you said, continuing to watch the market, monitor these various metrics, and looking to take action in client portfolios when we deem it appropriate. Folks can reach out to us if they have concerns or questions. It's possible after the last couple of years, maybe we've gotten a bit complacent and willing to take more risk than they're comfortable with. And if you remember, on an annual basis, we should see the market pull back historically 10 to 15% in any given year. So if we do get some sort of a more significant pullback, it won't be unusual. It'll be unusual compared to the last couple of years.
Right.
But it won't be unusual historically. But it doesn't feel very good. So if people are concerned or have questions, they certainly can reach out and we can have a conversation about what we're doing in their portfolio and any changes that are appropriate to consider.
And that's a really good point. And I would add, if you're uncomfortable when the S&P is down by 2% and you're reading the news and you're freaking out and you're compelled to do something, you're probably taking too much risk in your portfolio and you're not invested correctly. What we see during good times is people get over their skis with risk, chasing performance. They want to get while the getting is good. And then when markets flip, which is the cost of admission, like you can't get 8% a year long-term average without the occasional blip. When markets flip, they shun risk and they panic. And that tells me that they're not invested correctly. So know that there's no green light that flashes in markets when you're an equity investor that says, hey, there's no risk here. There's nothing to see here. You have a license to get fully invested in the riskiest corners of the market and print money. Markets correcting, markets going down, uncertainty. This is all the cost of admission. It's not a bug in the system. It's very normal.
Yeah, and I think folks are less concerned about the 2% and more concerned about the 2% becoming 5, 10, 15, 20%. So something we'll have continue to keep an eye on. The next item I had on my list was, and you alluded to it in the first comment, was talk a little bit about the rotation that we've seen in 2025. It's different not only from last year and the year before, but really different from what we've seen over the last 5 to 10 to 15 years. And again, it's only a couple of months, so it's hard to know whether it's a new trend or whether it's just a blip. But talk a little bit about the rotation we've seen in the new year.
Yeah, it feels like the AI trade has become a bit fatigued. And a lot had to go right for those names to continue to go higher. And it's a big deal. And we talk about it a lot because these 7, 8 companies make up and explain a good chunk of the S&P 500's performance. So when you look back at history, it's not uncommon for what's worked to stop working and what's been out of favor to start working. And that sounds very simplistic, but when you look back at history, the baton often gets passed from what's worked or what hasn't worked. And investors, again, tend to overweight what just happened, and what just happened is U.S. large caps have had one of the best runs that we've seen ever. So this rotation, there's nothing sacred about it. It just follows the natural rhythm of markets where what's beaten down becomes in favor. And basically everything that I rattled off, from real estate to value, foreign stocks, emerging market stocks, have been deeply out of favor. And investors don't look backwards and say, what's work? I'm going to pile in there. Savvy investors look at the opportunity set out there and say, based on today, what's an attractive risk return trade-off? And I think a lot of that has just flipped, where some of the valuation, some of the cheaper asset classes, the beaten down nature of those asset classes, the beaten down price really is the hedge and attraction. Like the downside is basically muted and the future opportunity looks a lot brighter from a risk return standpoint. So I think that's all that's happening. I'm not saying folks can't earn a reasonable return in US stocks, but from these levels, a lot has to go right. And when you zoom out and look at history again, from these levels, I think we're trading at the 99th percentile for US large cap stocks. From these levels, future returns are right around zero. So I think investors would do well just to revise their expectations down for U.S. large caps.
And it's also an argument for diversification. We tend to preach diversification, but sometimes folks look at that and say, well, wait a minute, why do I own these asset classes that are underperforming year in and year out? And being diversified means you're always going to be disappointed in the returns of something in the portfolio while you have other things that are carrying the baton. So it's nice to see some of the areas that have been lagging the last several years start to do a little bit better in 2025 and provide a bit of an offset to the Mag 7 and NASDAQ that's been so strong over the recent history.
Yes, I think that's a good point because we are not a hedge fund. Like our investors don't tell us, squeeze every bit of return out of this and shun risk or have your head in the sand when it comes to risk. 70 to 80% of our clients are retired or about to retire. We're very focused on generating reasonable returns while being mindful of risk. Most of our clients can't take a 20, 30% drawdown. So everything that we do, we tend to lead with risk first. And then, of course, we're paying attention to performance. But as professional investors, when the S&P is down by 10%, we want to understand how our portfolios are acting in that context. And often, if the S&P is down 10%, our portfolios are down 4% or maybe even 5%. And that's the bonds, the gold, the other equity asset classes doing well to mitigate some of that downside risk. And even in this year, I think we were just talking, a lot of our portfolios are positive year to date, just because we've really leaned into some of those other asset classes, and it probably hurt our performance in previous years, but it's really been a tailwind to us in 2025.
Yeah, and gold is another example of that. We've owned gold in the portfolio as long as I've been involved, and gold is up another 10, 11% so far in 2025, and it tends to act as a buffer in the portfolio against some of the equity asset classes. So our focus on risk is really important, especially so when we see the market being more difficult or challenging or volatile.
What are some of the things that you pay attention to when markets are difficult? Do you have any sources of information or metrics that you're personally tracking?
Yeah, I wouldn't say that I have specific metrics that I track, but as do you, I do a lot of reading, and I tend to make sure that I'm reading the latest information from the various sources. And I use that to kind of build a mosaic, if you will, of what I think about the market. And you have to be careful when you're reading newsletters and commentary and blog posts to make sure you're not just confirming your own bias. But I like to read as many different sources as I can find, including ones that I don't necessarily agree with, because it helps me get a better understanding of what's going on in the market. So no specific metrics that I'm following, but that's kind of how I approach things when things get more volatile.
One thing that stuck out to me, and I'm not sure if you caught this, but investor sentiment turned wildly bearish like a week ago. And we were 2% from all-time highs on the S&P 500. That's
Unusual.
very rare. I'm curious if you saw that and what you make of that, because as you know, I really follow sentiment. I always say that I can never predict the next crisis, but I can predict how humans are going to respond to that crisis.
Yeah, I think you could almost see this coming with the change in the administration. I know we try to be agnostic when it comes to politics, but with the change, there's such strong feelings about the new administration, and the new administration was coming in with ideas and new people and things that they wanted to get done and get done quickly. And so I think people were already kind of concerned that that could be a good thing, but it also could be a bad thing. And given how the market has performed the last couple of years, I don't think people would be surprised if that volatility was a bad thing. And so I think people are kind of one foot out the door, concerned about what's going on. And then now the market is starting to confirm that. And so I think that's why sentiment was so bad, even though we really aren't that far away from all-time highs.
Yeah, and to piggyback off that, another survey that I saw, and the data can be noisy month to month, but it was like future consumer expectations on the economy. And it took a little dip in February. But when you drilled down, Republicans, our right-leaning friends, thought things would be great. And our left-leaning friends thought the world was going to hell in a handbasket. So as much as we preach, do not mix investing in politics, it's really hard in this 24/7 news cycle. We're hit with headlines. We have cell phones. It just can bleed into how you feel about your economic prospects. It can bleed into your investment portfolio. And it's just something that we really try to strip out of our investment process. And as you said, clients want to talk about it, but we can't really talk about it because regardless of what we say, you're going to piss off half of the folks in which we work with.
Sure. Yeah, and I also think you have other factors going on in the economy that weigh on people. Inflation has come down quite a bit, but it hasn't gone backwards. So prices today are still 20, 25%, 30% higher than they were 4 or 5 years ago. That weighs on people trying to stretch their paycheck to the end of the month. I think the job market, the unemployment rate is fairly low. A lot of that has been masked with government hiring. And I think the underlying job market may not be as strong as we think. You talk to people that are out looking for a job. I have a recent college graduate who's out looking for a job, and there just aren't a lot of jobs to be had at the moment. So you combine a tight job market with inflation and some other concerns, and then you layer on the political situation, and it just provides a brew of concern for a lot of folks.
Yeah, and I think that's a good point. The public sector over the past, call it 4+ years, has become so big. The federal government, this probably won't be a political statement, or at least it's not intended to be, but you could argue that the rate of our deficit is not sustainable. And I don't know the answer, but you could argue going on our current path of spending like drunken sailors is the riskiest path of all. Now, I don't agree with everything that's going on, but certainly tightening up our fiscal household, shrinking federal spend is not optional. It has to happen, and it's going to be painful. And I think that's going to be the biggest adjustment. And we track government spending, and right now it hasn't really changed from 24 to 25. But once that fire hose goes away, I think you might see some pockets of pain. And I think some of that is starting to show up in the economic data and the GDP numbers, which were revised down. But certainly folks that are upset about all this Doge stuff, again, I don't necessarily agree with the approach, but something has to happen. The current path of running multi-trillion-dollar deficits year over year is not sustainable. You talk about inflation, you talk about the lack of purchasing power, you talk about unrest. All of those things come with a government that can't control their spending.
Yeah, I think that's well said. And a lot of the stuff that I read hits that head on and says we've been kicking the can down the road with deficits, with the debt load that we have, and at some point it's going to have to be addressed. And maybe this is the start of that process. But to your point, it's hard to see how that's a sustainable path that we are on. And so something's likely going to have to change. And obviously, our focus is making sure we understand the impact to the economy and the impact to financial markets, and be ready to respond appropriately to that as we see those changes start to materialize.
Yeah, and just a reminder for folks, know that this is all that we do. So we're constantly looking at our rules, looking at client portfolios, looking at how the various asset classes move in relation to the broader market. We run our rules at the beginning of the new month. So every single month, we're running every single equity asset class through a series of rules, and then we either add risk, hold, or pair risks. So it's not based on what I think. It's not based on what Toby thinks. It's a very quantitative approach designed to strip emotion out of the investment process and mitigate downside risk. With that, we're coming up on 30 minutes. This is Happy Half Hour. So we're going to end it here. Toby Weber, Nick Shermans. We'll see you next month.
Thank you.
Take care.